Hey guys, I'm Big Mike, and like always, I'd like to thank you for being here today. Today we welcome back Corey Rosenbloom for a special webinar presentation as part of our June 4-year anniversary. He's got several things he wants to talk about today, all centered around anticipating reversals in advance. Some of the bullet points include explanation of the major market internals, examples of the two-step progression from divergence to kickoff from internals. That's a term that Corey uses a lot. How spikes in internals are not simply overbought or oversold, but instead signs of strength or weakness, and trade triggers and stop-loss locations for low-risk intraday trading and reversal opportunities. If you did not see Corey's first webinar on BMT, I definitely recommend it. It's been a very highly rated webinar. Also, as part of the 4-year anniversary, we've been giving away some really fantastic prizes in all of the webinars all month long. And we still have today's webinar plus one Thursday and one Friday, and then we'll conclude that. So the prizes that we're giving away today are 10 autographed copies of Corey's book titled The Complete Trading Course. So Corey is going to autograph those, and then he'll give them back to me, and I'll get them out to the winners. So there's going to be 10 quiz questions at the end of the webinar. You're going to want to pay close attention to the content Corey covers so that you can answer those questions. Also, the webinar today is sponsored by Mirus Futures. Mirus is actually who introduced Corey to BMT a few months ago. And we're going to get started first by turning things over to Bob. He's going to go over what Mirus Futures offers very quickly. And then we're going to turn things over to Corey for the bulk of the presentation. So with that, I'm going to turn things over to Bob at Mirus Futures right now. And Bob, you should be good to go.
Show my screen here. Let me know that you guys can see this.
We can see it and we can hear you. Thanks, Bob.
Perfect. Well, thank you very much, Mike. Really happy to be back in the room, especially celebrating your 4-year anniversary. And as we're winding down the event series, happy to be introducing Corey as well, longtime partner of Mirus. And with that, I just want to thank everybody in the room for joining us. Really quickly, I'm going to take you through a little bit about who Mirus is, what we do, and what you can expect from us in the future. So Mirus was actually founded in 2004 as a brokerage firm focused on providing advanced technology, service, and support to a wide range of traders and money managers. We're really proud to be the first brokerage firm to offer the extremely fast and reliable Zenfire trading engine, which many of you might know being in the Big Mike's room. We've really grown our reputation on our personal approach and proactive support, which empower traders around the globe, whether they are self-directed, whether they're working with money managers, or are part of a broker-assisted automated trading system. As an introducing broker, Mirus Futures and its clients work with futures commissions merchants, or FCMs, who provide 3 main functions to our clientele. First, the clearing firms hold customer funds in a segregated account in the customer's name. At the end of the day, the clearing firm clears and settles the trades made by you and provides the customer with the daily, monthly, and year-end statements for their trading. Mirus is currently working with 3 main FCM partners. Dorman Trading, Rosenthal, Collins Group are names that you may be familiar with. They've been in the industry for quite some time, and we've recently introduced R.J. O'Brien, who is also a longtime FCM in Chicago. Very reputable firms, and we're very pleased to be working with each one of them. There are some differences in the different clearing relationships that we have. For example, Margin requirements may be different depending on which clearing partner you choose to open an account with. My recommendation would be to speak with one of our brokers here who can help you find the right clearing partner for your account. As I mentioned before, Mirus is an introducing broker, and we're independent, meaning that we're able to work with those multiple clearing firms. What we really do is provide you, the client, with the tools and resources necessary for you to efficiently manage your account, whether that's the trading engine, which, as I mentioned earlier, is Zenfire, in providing market data and order routing technologies. Zenfire works with many front-end software platforms. Just a few are on this list that you see in front of you, and many of you might be familiar with one, if not, a multiple of the platforms that you see there. So it's really flexible in terms of which trading applications you choose to work with. We will likely be able to support with our fast and reliable Zenfire trading engine. Zenfire also gives us the ability to manage risk in-house, which is something that up until just a few years ago, introducing brokers really didn't handle much on their own. It was really up to the clearing firms to provide this service. But Zenfire, in many ways, has changed the industry, and Zenfire does allow us to manage the risk in-house. So if you have an emergency situation as they come up in electronic trading, we can efficiently handle your request to cancel orders, get out of positions, place orders, etc. through our emergency trade desk. And we also really focus on providing you the tools such as a treasury desk to help with requests on inbound or outgoing wires. We have an in-house team of support representatives that can help you troubleshoot issues that you may be having with one of the front-end platforms that we support. They're also really knowledgeable about the industry. All of the support reps are licensed brokers, so they can speak intelligently about order types, services that we offer here at Mirus, brokerage services, including the Trade Assist and the Managed Futures programs as well. And we also have our new accounts department who can really help you through opening the new account. Sometimes when you're opening a corporate account, an LLC, things can get a little bit confusing sometimes for customers, and the new accounts team can really outline what is needed to open the account. In addition to that, Mirus has a technology arm. As I mentioned, we developed the Zenfire technology. We continue to focus our efforts on providing the very best in technology to our customers, and in the next several months you'll be seeing some advancements on the technology side as well. So we're really excited to be bringing those forward to you, and it's projects that we've been working on for years now that are just coming to light now. So back in, I can't remember the last time we were in the room, but it was earlier this year we introduced the Mirus Trader platform, and that's just one of the ways that we're going to be providing evolving technologies to our futures traders in providing a web and mobile based software that utilizes server-side technology to better support our customers. So as I mentioned, we're really excited to be kind of finalizing and wrapping up some of those projects and bringing those to you in the near term. As it is, we're currently beta testing in those now and are going to be bringing them out sometime this year. So just wanted to finish up in mentioning a few things that, again, reiterating that we've really grown our reputation on bringing the highest levels of customer service and client interaction with regards to this technical support team, as well as our education departments. Our support team interacts through remote desktop support so that we can offer that live support to our customers. Also, we've grown on the education side as well through online training videos and multiple live weekly webinars with quality speakers and futures trading educators such as Corey. We also have two people in-house, Rich Riley and Dwayne Paul from Mirus Futures, who really have a lot to say. Rich was a long-time floor trader on the CME and really speaks to trading psychology, and Dwayne focuses his efforts on the managed futures portfolios that we offer, and both are extremely knowledgeable in the subjects that they speak on. And we've really built out a lot of our education this year through those guys. You can register for a free demo account of the Zenfire trading engine directly on our homepage, which is www.mirusfeatures.com. It'll give you 30 days of free access to the real-time market data from Zenfire, along with your platform of choice. And I just wanted to thank Mike and Corey and those of you who are in attendance here today. And with that, just want to introduce Corey Rosenbloom.
Okay. Thank you, Bob. And if anybody has any further questions for Mirus Futures, you can check out their website right there, mirusfutures.com, or call them or send them an email. Okay, guys, give me 1 second. I'm going to turn things over to Corey. All right, Corey, you should now have control.
All right. Everybody can hear me okay? To make sure we're okay for the sound, we can share the screen and we'll be ready. Can you see the screen? I'm not seeing the...
Yeah, we can see it. Can you go full screen mode on that?
Absolutely. Let's see if in the current, there we go.
All right, let's
go. Everybody's okay?
Thanks, Corey.
Excellent again. Well, thank you to Bob, first of all, and Mirus Futures, everybody there with of course, their commitment to trader education and for making this webinar being the sponsor. Thank you so much for that. And, of course, for Mike, Big Mike Trading, it's a great honor. It's a great pleasure to be back, and really had a great time last time with the questions and the interactions. So I'm looking forward for more of that. And at the end of it, it's a 10 giveaway book sort of contest. So be sure to pay attention to every word we say, hopefully. But I'll kind of give some hints in terms of what I'll be focusing on, what will be most important, and really what I'll highlight in the 10 questions. And we'll go through that. Mike will give us a detail on how to go through that at the end of it. But take notes. One thing I love to do when I attend presentations or webinars is take a lot of notes. And they will be archived. And one other plug for Big Mike, I was going through the archive videos, and there's a ton of material, a ton of webinars, and the same with Mirus Futures as well. So just be aware all that material is there for recorded webinars, and this will be recorded too. So any kind of questions as we go through, I'll pause in the middle for really kind of a conversational Q&A, make sure we're all on target. At the end of it, a Q&A at the end, and then you'll have the archive for any kind of detail, look at a chart again, and make sure you understand the concepts. But again, thank you to everyone for attending today. Let's go ahead and jump into the presentation. It's anticipating trend reversals, specifically focusing on two components, which is the divergence and kickoff, using internals, using momentum, and really identifying trend reversals as early as possible. And we'll build the foundation from one of my favorite quotes, which tends to be the foundation of technical analysis. That's given to us by Martin Breen. But all trading does involve risk. We'll go ahead and obviously it would be nice if every single trade we put on worked, but that's not the case. And just putting the probability, putting the edge in our favor. At the end of the presentation, we'll actually talk about some of the style of retracement trades you can take, how to manage risk, when to enter. We'll actually look at two different ways to enter, trailing a stop versus putting a fixed stop, all that fun stuff, things about execution that may not be as fun as a concept, but when you really get to trading, that's where the edge and the most important factors are. our excellence on execution. So the outline for the presentation today, we'll talk about these concepts, what momentum is and how I work with momentum using a somewhat non-traditional interpretation of classical indicators. So we'll look at how to almost turn conventional wisdom on its head and view these indicators not as overbought, oversold in terms of a high reading, but use that as a, quote, sign of strength or a sign of weakness in terms of probability for trend reversal. We'll again look at trading tactics, and that's we'll focus on retracements mainly. We don't typically trade reversals. At least I don't focus my style on reversals. I'm much more of a pro-trend retracement style trader. But of course, you can easily apply this to reversal style trades. It's a concept, and of course, as the trend reverses, we play in that direction. And while I'll try to focus a lot on intraday tactics, that's where I tend to focus a lot on the S&P futures, we'll actually broaden the perspective for this presentation to look at other markets, including gold and stocks. Apple features prominently in the presentation. So we'll go ahead with those examples to show that this presentation, this concept, this really important factor of trend reversals is applicable to look at 1-minute charts, 5-minute charts, hourly charts, daily and even weekly, and it spans all markets and, of course, futures, Forex. We don't look at Forex, but that's what we do. So just as a broad-based presentation in terms of using momentum, using divergences to highlight probabilities of trend reversals and really what to do and how to manage. But again, focusing on mainly on just simple core trades, nothing fancy, nothing out of the ordinary, looking at pro-trend retracements, which typically are flags, bull flags or bear flags, and then reversal trades are more complicated, so we won't focus our presentation really on that, but the factors that precede trend reversals. And of course, breakouts, we'll save that for another presentation. My favorite quote, really, as a trader, as a technical analyst, during the Charter Market Technician program, one of the first books they make you read is Technical Analysis Explained by Martin Pring, who's called The Technician's Technician. And one of the first sentences in that book, a very large book, very important book, is this, and it's stuck with me ever since. What we do as a trader, what we do as a technical analyst or a charter, it's simply the art, not the science necessarily, but the art of identifying a trend reversal at the earliest stages and then trading in that direction of the trend until the weight of the evidence has proved, using again charts, that the trend has reversed. And of course, this style and tactics being retracement trades, reversal trades play into the actual trend reversal itself, much more aggressive, but this really is the core, the foundation. It's the art, trend reversal as soon as possible, and then trading in that direction until the weight of the evidence, basically what that says is the opposite reversal takes place. And what we call a momentum burst or kickoffs or impulses, lots of words for the same concept. We're all looking at the same chart. We're using similar concepts to find the same shift, really, in supply-demand relationship. Call it a burst, call it an impulse. That's part of the early evidence formula for reversals. When I first started trading, I really came in 1998-99 as more of a fundamental stock picker and was introduced to technical analysis during the bear market of 2000 and 2001, particularly 2002, and that's when I got my interest in technical analysis. And one of the first things I was drawn to was candle charts, just for interesting reason. I've always been interested in candle charts, but also overbought, oversold oscillators. And in this case, rate of change, RSI, and I would print off charts and really of stocks and look at the RSI and the stochastic and try to find points to buy, really, at that point, not without respect to a trend, just if the stock or if the ETF, if the issue is overbought or oversold, I want to go ahead and buy that to hopefully get a profitable trade. So this is typical, this is classic of how we use indicators or oscillators. And I want to call this a curious case of a pro-trend Apple and the oscillators. So just the way we typically identify this is anything overbought, oversold, we'll go ahead and buy when the oscillator tips to the low level. For RSI, it's 30 for oversold, and of course 70 for overbought. Stochastic is 2080, and of course you can use CCI for commodity channel index, rate of change, so on and so forth. But the goal, as we're typically taught, is to use them as overbought, oversold. So in this case, a sell trade would take place when the oscillator is at the top. RSI is above 70 and hooks back over, et cetera, et cetera. But when you're looking at a trend, if you don't use the trend analysis or the foundation being trend continuity, you can get into trouble. Trouble two ways. One, short selling or taking profits at an overbought level, or worse, this is what happened to me most of the time in terms of a down market, when you buy overly oversold readings, when the oscillator is at the lows, but it's in the context of a downtrend. So you may get a couple of days, may get a couple of, maybe even a week as a swing trader, but what you're really doing is trading against the trend. So if this has happened to you, this is a very common thing, but what I want to show and really create the rest of the presentation on is how to turn this overbought, oversold notion on its head. So now let's go to the next slide, and it's the exact same chart using the same rate of change, just default 14 period. RSI also default 14, and instead of using them as buy and sell or take profit indicators to generate trades, let's look at them as concepts. We won't trade off of them, but we'll start with a trend and then go from that. And that's what the focus of the presentation will be. So we'll come back to this chart really. But looking at the push up off the 2009 low, but what we're seeing is A, divergences in both indicators, and B, new momentum or new oscillator, new indicator highs, which would be typically seen as a sell short signal. Especially the higher the oscillator goes, the more we want to get short. Well, let's reverse that thinking and use that as a concept that says this is happening for a reason. The oscillator is making these highs because of a clear and pronounced impulse shift in the supply-demand relationship. First off with the divergences as a loss of momentum, and second with the peaks as a gain. So the same thing, instead of saying overbought, let's look at these as signs of confirmation. Confirmation being the price is making a new high, and so is the oscillator. And instead, we're not going to short sell this, but see this as a concept. And it says this is strength. This is really supporting the evidence of a trend continuing. We'll make this into a principle to make it easier, but just showing this to get the presentation started. But now as Apple moves into 2012, you still see strength in the early part of April as you push to 650 per share. One more retracement. Of course, as you got to 700, October, late 2012, that's when you saw A, divergences. In other words, the oscillator was making a lower high relative to the actual high. And then B, which is the two-step process, Apple shares pushed to, or actually the oscillator, pushed to new lows. Here's the important point, not seen in the entirety of the bull market. So that's the key that we'll build from the presentation. It's when the oscillator A makes divergences or internals, as we'll look at intraday, volume. This concept works with volume too. When you initially have a divergence in an uptrend, and then you have a push in the oscillator to a new visual low, or a new visual high in the case of a downtrend reversing to an uptrend. So let's go ahead and arrange these in terms of, hint, 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 for the question and answer session, two principles. One, trend continuity simply states, and again this is a foundational principle from Dow theory, from Wyckoff, Schabacker, Edwards, and McGee. As a technician, we focus on trends typically. That once established, a trend has greater odds of continuing or of continuity than of reversing. Very important. Always trade with the trend. The trend is your friend. There's all sorts of sayings that go with that, but I like this principle, these terms. Trends, once established, have greater odds of continuing than of reversing. But not all trends last forever. That's obvious. Not even gold, not even Apple, not even Google. These things tend to reverse in time, and that's what we're focusing on. What factors precede reversals? We look to momentum, and this is for signs of confirmation or non-confirmation, such that a new momentum high precedes future price highs. We saw that in Apple. As the oscillator peaked, as price also peaked, that was a sign of strength, and that really forecasted, or at least suggested, the odds favored the trend to continue. But there's a downside. Momentum divergences, or non-confirmation, where the oscillator makes a lower high and the price makes a higher high, that tends to precede reversals. Not always, it's just a factor to watch. The kickoff makes this even more important, but this is a factor. New highs or confirmation tends to precede the trend continuing, or higher highs yet to come. Divergences suggest the opposite, which is non-confirmation, loss of momentum, loss of buying pressure, or a shift in the supply-demand relationship, and that tends to precede price reversals. So foundationally, we'll see lots of examples of how this works. A surge of momentum during an uptrend suggests trend continuity, and we'll go ahead and build retracement trade strategies from that. Intraday, daily, swing trader, even position trader. A surge of momentum, however, after a divergence or loss of momentum, tends to signal the birth of a new trend, which is to say the reversal of a mature or an old trend. So we'll define momentum, and there's lots of ways you can look at it, but just think of it as a concept at this point, not so much an oscillator or whatever the case is. Just it's the principle of confirmation, non-confirmation. So think of physics. The harder you throw something up into the air, the higher or the farther up it's going to travel. Eventually it stalls, pauses. The momentum or the acceleration, how fast it leaves your hand, will slow, stop, decline really, or diverge, and then reverse back to Earth. Same thing really is true in terms of supply-demand. And momentum impulses, the kickoff, the burst, the confirmation, those reveal large-scale shifts or differences in the supply-demand relationship. Those show up on our charts as specific ways to interpret indicators. So that's the main idea. It's just the stronger you throw something, the harder the kickoff, or the bigger the supply-demand initial imbalance, the further the object is likely to go, or further the trend is likely to go. But eventually that stalls, declines, diverges, and then falls back to Earth, or reverses the trend. So divergences in themselves, just to solidify the concept, warn of price reversals. They're non-confirmations in the oscillator, market internal, volume, or anything else you look at that's a confirming, non-confirming variable. Again, price is forming a higher high. You can see this here in the chart on the right. But the oscillator, or breadth, or tick, or volume, or internals, forms a lower high. So a loss of momentum tends to precede a retracement swing. Strong, lengthy, multi-divergences in terms of 2 swings, 3, 4, the larger it gets, that tends to precede reversals. So one little divergence does not reverse a trend. One singular divergence is not a factor to say trend reversal, but a lengthy, visual, some might say obvious, non-confirmation tends to be a factor ahead of a distribution or accumulation, or just a shift in the supply-demand relationship. Let's talk about how trends get started. So think of this from the physics principle of just throwing a ball into the air. The harder it's thrown, the faster the initial impulse is, the quicker it moves away from your hand, the further in the air it's going to go. So we show this on the chart really as an unbound oscillator, which means not using that stochastic or the RSI. Even though we saw earlier, you can do that. The RSI shows its own sense of momentum. But usually these work better with unbound oscillators. Rate of change is what we're looking for the presentation here. 310 oscillator, the oscillator called momentum, etc. There's a lot of ways you can factor these sort of principles. This is a concept from Richard Wyckoff. It talks about hidden signals or signs of strength, signs of weakness, that the initial swing, and if we're looking at this chart, see this swing here, this quick little movement up that breaks a trend line, with the exception of a break of a trend line, that swing has no significance whatsoever. It broke a prior high, but this was the same price distance, so was that. So what's different about this? Looking beneath the price, showing A, divergences, B, new spike or new impulse or new high in the oscillator, again, internal volume. That's what makes this price swing qualitatively or visually different than the others. So combined with the divergence, these are hidden or secret signs of strength that tend to precede reversals. Although, of course, just for real trading, they don't guarantee them, but of course we're looking for probability and odds. So a momentum spike, which is a noticeable new high, just again defining it, price is not at the new high. So this we're comparing the absolute high of the oscillator, just to almost draw a vertical line. The indicator is making a visual new high, but price is nowhere near that high. That's what we're looking for. That's the kickoff. That's a sign of strength. It's very important for traders, A, to stop shorting or stop playing in the direction of the downtrend and look for signs of new trend or bullish trend to develop. This is your two-step process. And of course, divergences plus the kickoff. And again, Richard Wyckoff called it signs of strength, signs of weakness. So again, for this presentation, we'll look at rate of change, just because that's an indicator on everybody's chart. You can pull up the ROC. Default, I think, is either 10 or 14, depending on your program, and that's what we're looking for. It's just comparing the price now as opposed to 10 bars ago or 14 bars ago, and that puts it into a percentage. So maybe the market's 2% higher or 0.5% higher, etc. That's what the indicator shows. It's just comparing right now with prior levels 10 periods ago, and it's put into an indicator. Linda Raschke uses the 310, which is what I use primarily, MACD. That does involve a little bit of programming, or at least a little bit of changing the default setting of the MACD to periods 310, 16, or 310 just to get the differential. But the main idea is the same kind of issue, comparing two moving averages. There's an indicator called momentum, which is it doesn't put into a percentage, it's just the raw price data, versus ROC, which is your percentage base, and counter channel, which is two average true ranges. A penetration or close outside of that is a sign of momentum. Think of it like the Bollinger Band. The Bollinger Band uses standard deviation. The counter channel uses average true range, a little more stable. But either way, you can use Bollingers too. But just what my main purpose is to show this slide is to show there's multiple ways to show the same concept. For our presentation, we'll focus on breadth and tick, which are internals, volume and open interest. So if you're using futures. So just to go with before we look at the trading tactics, this is the 2009 stock market low. And same kind of issue, early signs of strength, not really shown with divergences until you see the actual March low. This is standard rate of change, no alteration to it. So divergence into the 6,000 thereabout low, and again, this initial push off the low into April really wasn't much different in terms of price structure than the prior counter trend retracements. What was different was the new high. In the rate of change, you also saw this in breadth, if you're looking at breadth on the course of the daily chart, and of course any other momentum indicator. We're showing a new high after a divergence with the trendline break. So there's your Martin Pring weight of the evidence model. There was, of course, much more. You can use Elliott wave, but just keeping it simple. Break above a trend line after a divergence with a spike in momentum. And that was your market low. The market top, just going backwards a couple of years from the low, same thing. Divergences into the peak slightly. Early signs of loss of momentum or signs of strength on the bear, signs of weaknesses for price. Initial kickoff, secondary kickoff, and the market fell from there. So the trend reversal, another kind of factor, is not a magical event. It's not an event that takes place on one single day. It usually takes place with long-term distribution. The head and shoulders pattern tends to play into this factor. Other chart patterns, broadening tops, etc. So this is not exclusive of any other work that you do. Pattern recognition, other indicators, etc. Just another way to look at oscillators, really, and how to put the weight of the evidence as opposed to being biased to the bullish side or biased to the bearish side. Or sometimes I work with traders and you find out they don't know what to look for in terms of trend structure, which is fine, especially for new traders. We have to learn and start somewhere. For me, it's foundational trend analysis. And of course, what confirmation, non-confirmation of trends in motion. So we'll take this is about the halfway point. I mentioned to Mike that we'll take a break in the middle to do questions because we'll focus on internals, breadth and tick, and look at the trading example. So any questions so far on kickoff, trend structure, Martin Pring's definition, or anything so far before we go to the next half of the presentation?
Right. Okay, guys, if you have questions, let me know. So far, I'm actually not seeing any, so you're doing a good job, Corey.
Awesome.
Let's see if anything pops up. Okay, I thought that they might. Here comes a few.
Okay.
All right. Doc is asking, do you by chance have any more recent charts to show us?
Yeah, absolutely. We'll look at some. Actually, we'll look at yesterday's. I think yesterday's or the 24th. So yeah, we'll look at one directly from yesterday's session.
Okay. Gary's asking how volume works with this.
Yeah, the Wyckoff, actually, if you look at Wyckoff's original work, that's what he used. He didn't have computers in the 1940s or 50s, thereabout, 30s particularly. So Richard Wyckoff himself used the NYSE breadth, a little bit different than we would use it now. He also used volume. So for Wyckoff, it's the same kind of issue. Looking at the price moving lower in a downtrend, but yet volume drying up, volume forming divergences, or it's less volume. And yet, as the market moves up, or as the stock, in his case, broke higher, you would see a spike in volume. It's the same thing. He didn't, again, have indicators, but this is not that we would have computers. But he used volume and I think NYSE internals. Yeah, the same sort of issue.
Okay. That's all the questions I see right now, so we can keep going and then do more Q&A at the end.
Okay, we have. Excellent. Thank you. Thank you. I like the webinar structure, but I like the face-to-face presentation because you can actually see the traders and say, I don't get this, or can you re-explain that? So I like pausing in the middle to sort of make sure we're all on the same page. It's a lot to go over, but again, you'll have the recording, and you'll have to go back and do anything else that we've discussed that wasn't clear, or maybe you want to see the chart in more detail, you can certainly do that. The tick is a market internal, and it just measures, again, hint, 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 the issues, or in case you can look at it from the tick E, which is your Dow 30 stocks, TIKI. It's just what's ticking up or bidding up at an exact moment in time minus the stocks that are ticking down, or issues ticking down. So if you have, say for the Dow, ticky, you have 30 stocks, and if, say, 20 are pushing up and, let's say, 5 are pushing down, at that point it will be a tick E, or tick, of 15. If you have a etc. You can do the math on that too, but I like to use the NYSE tick, just a broader measure, and we'll see it overlaid with the price. That's the key factor. Not just looking at it in isolation, which is when I first learned the how to use a tick. That's what I would do, is just write down the tick is at positive 400, and that to me at this point is irrelevant. It has to be put in the context of the daily trend, and of course underlaid with the market itself, the price. So same thing with what we use for the rate of change. We'll compare the difference in the tick at the price extreme. And again, the question of volume. You would have a chart of volume too, but use relative volume. What that means is a lot of times you'll see the market push higher. Let's say it's a trend day, and you see the price making higher highs, higher lows, but yet volume going down. And you would say that's a divergence. That's actually not correct, in the sense of there's a functional structure to volume such that as the hours progress toward lunchtime, volume tends to decline or dry up. And of course, at the lunchtime, it's the lowest point of the day, and volume picks up toward the end. So it's just a smile. So what you would do is compare relative volume, but that's probably going beyond the structure of this presentation. But that's what, just don't look at volume in isolation on the intraday chart. Compare it in terms of relative volume to that particular 15-minute bar, 15-minute period over the last, say, 10 days or something. On the daily chart, that's fine. That doesn't come into play, but that is a factor on intraday charts with volume. In other words, you don't get a divergence in the morning necessarily. With breadth, it's just a similar issue, similar component, but it's more stable than tick, which can be very violent, very volatile. So it's a number of advancing issues or stocks on the session. So again, the Dow, there's 30. How many of those are up minus how many of those are down, and declining stocks. So that's going to give you the breadth number. So NYSE, again, I like to use it for the broader measure. It does have bond funds or inactive funds. So if you are particularly an S&P person, you might actually use the specific S&P breadth, which is 500 symbols, to get a sense of the motion. And you can do it as percent, how many stocks are advanced, if you're looking at the daily charts, et cetera, et cetera. But so the intraday charts are going to show more information. We'll look at all these things in much more detail. So for example, this is looking back, I guess last week, a week and a half ago, to internals, and really this is the S&P itself. Starting with the left side of the chart in April, we have again A and B, or 1 and 2, step 1, step 2, positive breadth divergences. In other words, price has made 3 new lows under 1560. Breadth actually pushed up. In other words, there were fewer stocks trading down for the session when the S&P traded to 1550. Tick, you saw the same thing. This is just the intraday tick high and low at that time, just charting tick in breadth. And as the S&P pushed higher, you saw, again, same thing. This is really not that much different in terms of price swing, and it's 20 or 25 points, but what was important was that breadth pushed to a new high. And same kind of thing, a little bit of divergence, but breadth picked up again on the spike up and, as May started. And the same thing, you see divergences, but as you see the prior high, slight divergences, but here's your kickoff. At this point, breadth as the indicator pushed to a low not seen since the middle of April. So did tick. So, and that was, of course, if you are a candle trader, that was the bearish engulfing. So it was a pretty big deal at that point. That's actually the market high so far. So what factors occurred in the intraday chart? A, divergences. B, the actual push to new breadth lows, new tick lows, not seen in the entirety of the intraday rally. More lows, actually breadth pushed lower at the end of May, but yet finally June, a little tiny rally, which we're down here now, but at the middle of June, start of June, positive breadth divergences, positive tick divergences into 1600. So for short-term traders, particularly intraday, planning out your session, this is something you really want to pay attention to, which is a market trading down into a key support level, which is an obvious 1600. Today was also played off that level too, to the downside coming up above it, and we saw divergences. So that was a key sign that odds favored, but didn't guarantee by any means, a reversal up. And of course, as that happened, divergences, and we're down. One more push lower, we'll see that as it updated. Just looking in this on May to June period, the same kind of issue at the top, just using numbers. Yeah, negative 1735 on the actual first push, that engulfing candle, and a couple days later, a couple sessions later, 2366 negative breadth. And I made a note that these tick lows, that's breadth, that's tick, not seen since November 14, 2012, and that was a key sign that the market was in trouble. And as it traded short term, you saw divergences into 1600 short-term reverse. We're not looking to play the future out 3 months. As an intraday short-term trader, we're really gauging the probabilities for the next session. So we look for real-time action to confirm, non-confirm, but this is how to use breadth, how to use internals. You can also use volume, of course momentum oscillators too, just for signs of confirmation. In other words, new price low, new indicator low suggests lower lows yet to come. And of course, divergences with a kickoff suggest higher highs. are likely to come, which trade in that direction. And for intraday traders, this applies to 1-minute charts. So I can just go through lots and lots of examples of this, which are, this is breadth, just take it one panel at a time. This is the S&P pushing back to 1672, S&P itself. And as the price was up into that new inflection high, we saw breadth. You can actually see it visually. The intraday chart was lower. In other words, there were fewer stocks. It was less than 1,000 net positive as the price pushed up to a new high. Tick clearly was down from the prior high and was at the 200 level, thereabout. And we're looking at rate of change, just to throw it back on the chart, as a momentum oscillator, not an internal. It's a price-based indicator, essentially, was diverging. That's factor 1. Factor 2 was new lows, and I put on my charts little red dots or green dots to highlight new highs or new lows. So on the first swing down from 1672 at 11 o'clock, 11:10 Central Time, tick made a new intraday low as price was coming off of the high. That's very significant, very important. And of course, breadth was lower, momentum was lower, and you see all these factors pushing, with the exception of breadth, which is more stable, pushing to new lows. Second kickoff, third kickoff, and a final boom at 12:30, and the market reversed. So if you really want to get into this, zooming in on the concept, it's maybe better just on the replay than to spend more time on it. But you can see the numbers and the factors, the actual zoom in of that thing as it happened in real time. Bullish retracement trades, bullish confirmation, divergences, non-confirmation. Here's your actual high. You don't know that in hindsight, in real time, but you just know that this uptrend is probably in danger and not just being non-confirmed by internals and momentum. The actual kickoff, the first kickoff in internals, momentum, and the market fell really about 10 points from there. And you would just trade retracements. We'll look at how to trade these things in the second part of the presentation. But here's your early sign. A, divergence. B, kickoff. This is what happened 2 days ago, actually, on June 24. We like to call these rounded reversals, or a market or an intraday trader would look to play in the direction of the gap, typically on a big gap, play retracement trades, but always be on guard for any sign of non-confirmation. This is, again, the rate of change, 3-10 oscillator, momentum, etc., with the tick. So not to belabor the point, I have lots more examples to go through, but tick is pushing to new highs even before the actual price low. As it pushed off this is the SPY for those that trade ETFs, 156, higher time frame support level, 1560 there about in the S&P. So higher time frame support, lower time frame divergence, lower time frame strength in internals, momentum, etc. So this is something you really want to watch as an intraday trader. The confirmation comes from a price breakout, and your trade, as we'll see this in detail, is what we call the first reaction or the first flag, first retracement, unless you like to trade breakouts, in which case this is a valid trade, initial breakout. I prefer retracements. You tend to get a better risk-reward characteristic. So again, not to belabor the point, but lots more examples. So, okay, so here's how to actually trade these things. Again, concept, trend, confirmation, non-confirmation, and trading it. It's one thing to see it. It's another thing to put the trade on and manage it appropriately. You don't make money seeing a great setup. You don't make money analyzing a great setup for that matter either. It's taking the risk on, putting the position on, executing, managing stops, playing for targets, etc. So again, you can't necessarily trade off the kickoff divergence concept. You need price. You need a break of a trend line. You need a break of a reversal candle, break of a moving average, something to trigger you in based on price. Because one divergence can lead to a second divergence, can lead to a third, and here you are short on the first divergence. The market's 3 to 4 points higher, so that's not what we want to do in terms of shorting a divergence. And the stop will be beyond the price high because you're playing for a reversal. It shouldn't go beyond that. And of course, you're allowing for, theoretically, unlimited targets. In the real world, that just means what Martin Pring said, playing the trend reversal and playing in the direction of that new trend until the weight of the evidence, which is beyond a single candle or beyond a single target level, suggests the trend has reversed. That would again be divergences, kickoff, trend line breaks in the opposite direction. So we look to trade these things, at least I do, on trend line breaks. Again, it's not enough to see these two-step process. I want to see the price break a trend line. I want to see it break a 5-minute candle, or in a daily chart break a reversal candle there. I don't typically swing trade as much as I used to, but as an intraday trader, you're looking for some sort of price-based proof, trend line break. On the first reaction, which is where I'm going to be mostly looking to put the trade in a position to go for on the intraday level, first reaction. If you like breakouts, you actually get a breakout opportunity. Tends to be more risk controlled on the first reaction against the kickoff signal. Into support resist. This is where you can get fancy. For the purpose of the presentation, we're not getting fancy, but moving average, Fibonacci, Elliott wave, any other kind of indicator that you use, any other kind of method that you use, there's where you can really get the your particular spin, your particular interest, or what works for you on how to enter the trade. So there's just not one specific way to enter a trade. There's an early signal, late signal, and you can use other factors than just a trend line. But keeping it simple, that tends to work. The stop will be simply beyond the most recent swing, because if it's a true reversal, it shouldn't go back above that, or give it a chance to go back one more time and then fall. So it won't be exactly on that point, but a little bit above it. And you'll trail that stop typically using the moving average or a new trend line that develops, or just pulling it under the prior swing high or swing low as a new trend emerges. So what are you targeting? You're technically playing for a reversal. So you can hold the core position. You can hold a position that doesn't have to be in and out trading, a short-term scalping. You can really put a position trade on or play around that. And then keep trading breakouts, particularly what I like is retracements, in that direction until that other reversal signal takes place. As an intraday trader, you have an artificial time limit, which is the close of the session. You can trade overnight. You can trade. You can hold trades into the next day, but typically I like to trade at exit at the end of the session. I to be a pure intraday trader. But if you're playing for a trend reversal, you can keep with the position. It's just as long as that supply-demand differential is in place. In other words, it continues. And you may get 2, 3, 4 other trades to take place. So for execution tactics, this is where we're going to differ based on our experience, based on our strategies, our style, the way we manage risk. And so I like to be more conservative, just the way that I tend to be an execution for trades, which what that is waiting for a little bit more proof. If you're aggressive, you may go ahead and put a position on at a key support level, at a trend line, at a moving average, or at a Fibonacci level. For example, at 1600, what we saw in the other example, or whatever the round number, the point that you think the chart tells you that the market has a good odds of reversing up off of or down from, that's where you'll execute right at that spot, as close as possible. Conservative traders tend to wait for something else. In other words, they're going to try to sidestep a market that hits a support level, bounces a little bit, and then breaks right through it. And the one way to do that is to be more conservative, which is to wait for additional proof. Reversal candle, 5-minute chart, daily chart, or a short-term trend line break. So something else. So that will be your flag, trend line break. As the market pushes down, or as the market hits a support level, limit orders are fine. Work the bid, work the offer. Get a little bit more execution on that, especially if you're using larger size. But if the market begins to move up off that level, trust me, technical analysis nowadays is common. There's a lot of education, so a lot of traders are much more sophisticated. And as the market comes off a very obvious support level, it can make a quick move more rapidly than we would like to play. And if you're playing limit orders, try to save a little bit on execution, and the market's in a trending or a volatile or a we're all doing about the same thing at the same time, your limit order probably won't get filled, and you'll miss that trade. So it's okay to use market orders if you did not get the excellence or the elegant entry. In other words, you don't want to miss a trade that's a very high probability event, as the market moves in the direction of your trade. And that's happened to me a lot of times, very common I would imagine, where you do the analysis, you see it happen in real time, and you don't put the trade on, or you want to get that perfect spot, and the market's moving, and it's moved away from my level. So I'm going to pass on the trade, and of course it does what you thought it was going to do, and you didn't make the money off of it. So that's of course not fun. Market orders can alleviate that, but of course that takes some strong will, strong knowledge, and of course a strong psychology. So yeah, I prefer wider stops. You can just let the market push a little bit higher, just testing that I've done in real world, and test wider stops tend to work more than not in terms of execution. Doesn't feel as good. Your position size may be smaller, but wider stops tend more than not to test out. In other words, you're giving room for a trap. Okay, so just for aggressive versus conservative techniques, same kind of issue. Aggressive traders buy at support, buying at support level, and aggressive will actually, aggressive buy at support, forget the candle. We don't know the candle's happening. This would be a red bar in real time. Or conservative can wait to break the candle high or break a trend line and execute from there. That's just one more factor, one more bit of proof. And as the market, the higher the time frame, the more slippage or more penalty, not so much penalty, but the more price action will take place against your position or slippage from where you wanted to enter, from the retracement point, than not. So on a 1 minute chart, this won't matter as much. On a daily chart, as showing here with Apple, it can matter a lot. So even the trade still worked out in terms of buying flags, buying support. You can miss $10 of a move, and of course, inherently, your stop would be wider. So I won't go too much into that beyond this, but aggressive versus conservative tactics, this is a factor that you will be dealing with as a retracement trader. So almost finished, but going through the large-scale dollar reversal. And so what we're looking at in this case is a larger concept picture, larger concept example that can be used for even 1 minute chart. The main idea for the presentation is to understand the A, divergence concept, B, kickoff concept, and now we're talking about how to trade it once you see it. And that's, for me at least, trading retracements, which are pro-trend flag events. You can be very sophisticated with it. You can be very simple with it. And just for the presentation of being simple, you can draw Fibonacci, et cetera, et cetera. But you're looking to, after a trend reversal, buy retracements. As the market moves higher, you're going to watch for additional signs of confirmation. In other words, this is a dollar pushing up, new high. You're really, not say safe and secure, but the odds of continuation are stronger when the momentum is in your favor. The strongest signal really is going to be the first reaction, first retracement. Same thing, just going inside of the intraday chart, divergence, push strongly up, and it's, again, how is this different than that? Not much, but it does push to a new high not seen in the entirety of this intraday movement. And you get a couple of retracements, so on and so forth. This is a recent example of the dollar that's also had an upside rally, but we'll take it left to right. So strength, here's some intraday flags, push divergence, kickoff, push lower, divergence into the 8150, strong up move, new momentum high, kickoff, push a secondary kickoff, retracement, divergence. So there's two retracement trades set up here. And as the market stalls, this one, it would have worked, but got a little bit smaller target, smaller move. And that's what I'm talking about. The longer the market trends and the more a divergence takes place, the lower the probability for a successful flag. You typically get the best odds from the first, maybe even the second movement. Pattern recognition comes in because this is a head and shoulders. So a head and shoulders, left shoulder, head, right shoulder. Also, we call this a rounded reversal, which is just a simple pattern that shows distribution, supply-demand differential change from the buyers to the sellers. And that's Think of the same thing as throwing that ball, or whatever the case is, into the air in the concept of physics. The stronger you throw it, the farther it's going to go, but eventually it's going to stall, pause, diverge, and then head back to Earth with its own set of kickoffs to the downside. So kickoff, 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 and final retracement. So a few more trades in the direction of that new trend. So just another quick one. I like Apple. Apple's a really fun name. This is a reversal up, similar to what we saw on the dollar, 2009. So same issue we saw it earlier. Divergence, divergence, divergence. Kickoff. Here's your first pullback, and here's what we talked about earlier. Let's talk about this before we conclude. This is where the stop would be placed. For trading, say, this first pullback, or whatever the case is, the market tried to retest the low, but didn't do it. So the stop would be placed for playing the breakout, particularly, not taking the retracement. You want to place your stop under the prior low. It came extraordinarily close, but buyers stepped in, held the price, and then we got our reversal. So just for stop loss management, a little bit beneath the prior low. And if it fails, the trend continued. And that can lead to a powerful move. Don't fight a trap or a false breakout. Those can be very damaging, particularly as the trend continues, actually. It's a false reversal may lead to a swift resumption of the trend. You saw that in gold recently with the today's session, gapped down quite a bit and stayed down the whole session. So potential for support in gold didn't happen. You get typically larger moves in the opposite direction when a trend reversal fails. A lot of people are trapped, so don't be one of the ones that's trapped. Anyway, breakout, retracement, retracement, back to the moving average, break the trend line. So one more on gold. So same kind of issue. Trend line, trend line, trend line, break of a trend line, new momentum low, and kickoffs. First reaction, there it is. Trail the stop, initial stop if you wish, or trailed above the prior swing high, above the moving average. Again, give it room because it can easily take a little bit above the average and then trade lower. It's all based on supply and demand. It's not based on charts. It's not based on Fibonacci. It's not based on moving averages. It's not based on magic. It's supply and demand. So if this were to take it out, there's a pocket of stops. Your stop would be taken out and the trend would reverse. If not, the trend is in motion. And we'll trade those retracement trades accordingly. Same thing, 143, positive divergence, kickoff, and A, stop shorting, because this was a intraday reversal. So I can't wait for the contest now. Almost finished. So let's go through the summary thoughts, and we'll take a Q&A session. We'll turn back to Mike for the book giveaway. But before we get there, just summarizing what we talked about, how to apply this. I really wanted the presentation to be broad and focused. Last time was an intraday presentation. You can easily, and that's what I do, is do intraday trading, but you can be a swing trader and use these same concepts. I made it a point to use examples from really large reversals. And I think the last time we had major reversals was the 2009 low in terms of stocks particularly, but because that uptrend's continued since then. So pardon the latency of the examples, but that's I want to make it as clear as possible. So they didn't work best with divergences. And the kickoff, make sure it's confirmed with a price breaking trend lines, breaking moving averages, and that's your signal. And this is Martin Pring. Identify a trend reversal at the earliest stage possible, basically earliest possible, and then trade with that trend until, which is retracement trades, particularly. The weight of the evidence has proven that the trend has reversed. That's just the same thing with divergences, trend line break, kickoffs, and you want to go with the trend unless you see those factors, because trends have greater odds of continuing than of reversing. So after a kickoff signal has been confirmed, which is your price basis, typically you would look to enter on the first reaction. It's your first flag, first retracement. You see this happen a lot of times on the intraday chart, but it happens in the larger frames too. It's your first spot. You typically get a tighter stop, and the odds typically are strongest for your stop is not that far away from the prior low, and it would be a failed signal. Not your fault. Don't take it personally. Just the trend was stronger. And trade breakouts, retracements in that direction until, once again, counter trend signals develop. and just for factors, looking at this is more for analysis perspective, but a kickoff or divergence that happens in a higher frame, that signals large-scale reversals. S&P, Dow, etc. You would typically want to use that in analysis if you're an intraday trader, planning a pathway for tomorrow's session. I like to do that with the reports that I do, with the other analysis that I do, is given what we have today, what is the probability of the market pushing higher tomorrow, trading lower, trading towards a target, trading away from a target, etc. So if you see these things at higher frames, hourly chart for a 5-minute trader, that can signal a more powerful example than, say, a 1-minute chart. And again, if you have questions that you don't want to ask publicly, in terms of what was that? You don't see the replay in the slides. You go back on the presentation replay, but Corey at afraidtotrade.com, and I'll go ahead and see the questions now. We'll turn back to Mike, take a little break, and I'll do some Q&A questions here.
Okay.
So, again, thank you all for a lot of questions.
Yeah, thanks, Corey. Okay,
go ahead, Mike.
So
I'm going to read some of the questions here.
Yeah, let's take a look at the questions. So, all right, guys, so go ahead and type your questions if you have them, and we'll get that taken care of real quick and then do the prizes. So Trantor is asking, basically to summarize this question, I guess, how much of this methodology is discretionary versus mechanical. He's asking if you've done any type of statistical analysis on these patterns. Because, I mean, I think you understand the question, so what's your answer?
It's a long question.
Yeah.
In terms of stats, you need to have stats. You need to have you either have your real trades, which is more, I think, profitable, more important than kind of a simulator or a backtesting method. You just kind of plug in indicators or plug in results and trade and really test that way. But when you actually have your own stats, your own material, and break it down by retracement trade, flag trade, first reaction, second reaction, etc. With Excel, you can do that with spreadsheets, and it tends to work well. A lot of mechanical, now I'm discretionary. I don't use this as a mechanical system. I've actually worked with people that try to do that, and just about every single person that I've talked to has said, okay, this is way too much to program, because I'm discretionary, and I like to look at the broader picture. I'm also, been talking about it, I look at sector rotation, big on intermarket analysis, other kind of factors of trends, and so I'm looking at multiple factors and that affect my trading, whether I'll be more aggressive, more conservative. So yeah, when I've tried to do this, and I would love to, trust me, I would love to have the kickoff and first reaction plotted and just sit back and do it, but maybe it work better, maybe not, but it doesn't seem to work for me. But yeah, what I've tested out in terms of real quick, metrics is target, in terms of breakout trades, retracements, target, stop, and you can really get good probabilities that way. So I've done a lot more methodological things that way than just too much to really, I think, quantify.
That's what I was going to suggest, is that, we had a webinar earlier this month. It's one of the special webinars on statistical analysis, and the presenter gave, from A to Z, how to get the data into Excel, what to look for, and I think that it's important to place at least as much, if not more, emphasis on doing the type of research that would maybe lead you to know how far the market typically, ranges, or, like you said, targets and stops, instead of focusing solely on, here's my indicator crossing 70 and this crossing 0. How many times does that happen?
Let me show something real quick here. I mean, if my screen's still live and I understand the trade station.
It is.
What I like to do is, this is on the blog sometimes, kind of this is kind of more esoteric, but I think important. And there's a couple of questions coming, so it's kind of going to tie in. But anyway, when you're looking at the tick, T-I-C-K, you'll see this is one of my pet peeves. I learned it this way, but same thing with volatility. Mike was right on the money with that. Adjust things for current market volatility, and so this is a tick. So if you're trading this, say, I've seen this 1,000 times, a tick value of 1,000 plus 1,000 is an automatic short sell. That drives me crazy. You can see here, this is the average. The black line is a 20-day average of the tick highs, and sometimes tick, particularly when it's a low volatility session, the average tick for early 2013 was 835. And there actually were no days whatsoever except for one in the first 3 months of 2013 that you even saw a tick of 1,000. So when you're looking raw numbers, same goes for volume for that matter too, you need to adjust. And statistical modeling does that. This is, again, you can't trade necessarily off of this. It's something that you have to know these factors about volatility, what the indicator calibration, basically. And so the same thing, if you're using a short sell tick of 1,000 when the market's very volatile, we can go back further, like this, you're seeing a tick 1,000 multiple times a day, and the average tick high is 1,200. So you can't just use random arbitrary tick numbers, and the same is true on breadth. And I'm again going to get esoteric here, but yeah, changing your metrics, it's something you have to test out yourself. You can't just take my word or anybody's word. Take your own metrics, take your own method, and apply it, learn it back and forth, because there's factors that volatility, trend do affect the performance.
Right. And you also have to, part of that is gaining the confidence in the method that speaks to your own style, right? Like whether or not you're a scalper, a day trader, a swing trader, so even if you do try to copy somebody else, you may not be comfortable enough with that methodology to make it successful as the original person was. So, at the end of the day, it's all about your own research and your own confidence in your own system.
Yeah, exactly. Right, exactly.
Okay. Gary's asking, he says a lot of us are futures traders, so most people on BMTR. What divergences do you look for in these markets? So do you find that this works, across pretty much any type of market, any type of product?
Yeah, let's look at this is today's session on the S&P, but it's all one on crude oil too. This is today's session off the SPY. Look at the ES futures as well. But gap up, back to the moving average, you see some internal divergences, and you don't see the kickoff. But the only reason you don't see the kickoff is because the opening tick was so strong on the gap. Pretend that didn't happen. And if you take away this initial session, you're seeing tick strength, particularly at 11 o'clock Central. That I hate to use the word forecast, but that was a factor that suggested with your divergence plus new tick highs, new indicator highs, that odds in its favor this push higher. There's your first reaction, second, third, etc. So it's happened today's session.
Right.
Prior, when this is what I used in the example, dual divergence 156. You can see the oscillator low, and then of course the tick from that point on. It's just multiple examples of that. Same thing, pushing lower. This is a 21st divergence kickoff. Didn't last too long, but it got a nice retracement to trade. So it's very short-term forecasting on the lower frame charts. But yeah, S&P futures, Dow. That's what I tend to focus on, is that, and don't overcomplicate it. There's so much to learn, and especially being a discretionary trader, you have to have a template. This happens at this time, and I'm looking for this, and it's either diverging or it's not. Make as much concrete as possible, and don't take the guesswork out. It's either diverging or it's not. So it's either trending or it's not. So I think it takes the guesswork out.
Okay. Tom's asking, on the entry, do you wait for the close of the candle, or do you enter the trade as soon as it breaks the trend line?
Well, it depends. I tend to wait for the close of the candle, because you've seen a lot of times, which is a personal preference, whether you like. I'm one that prefers a higher winning percentage, and I would rather prefer to chase that than, I know it sounds weird, but it's the way I am, a higher monetary edge. So I'm much more it's just the way I'm built. I'm just a conservative trader. So I want to wait for as much as possible. So I'll wait for the close, take out the close, because that also is supply-demand factors. So you'll see other people come in. You have more factors at your back, more factors, which is opposed to, you'll see on the lower frame charts, it's better in terms of money management or better in terms of risk control to enter at, say, pullback versus waiting for the trend line break. You can see just kind of examples from today, but it depends on the trader. So, yeah, it's just one of those things you can't really say, this is the way it should be, but it's your preference. My preference is for being fewer trades, more accurate trading, but yet as a consequence of that, I'm going to enter later than my colleagues or some even in my clients, for that matter, that would enter at the retracement. That either it works, it holds, it doesn't, but they'll be entering a better spot than me, which is waiting for a little bit more proof. So you'll just have to, again, that comes from experience. I just know that trade-offs, everything you do is going to be a trade-off.
Right.
Usually risk-reward of accuracy versus monetary edge. Monetary being your stop is how close your stop is to where your target is, basically.
Bob and a couple others actually are asking if you could take a look at crude oil and whether or not you
Yeah.
trade crude.
I don't trade it, but let's see. Looking at, is there a specific thing to look for, or today's session?
Yeah, I mean, today, I guess, the news, just in general, there's a lot of oil traders on BMT. That's, it kind of makes me cringe just a little bit every now and then. I used to trade crude exclusively for a couple of years, and I guess about the time the Arab Spring and all that happened, I stopped because the volatility was just insane. I couldn't do it, and it's a very fast moving market. So I'm a little afraid sometimes for the members on BMT because you can get killed so quickly on crude. There's so many other markets that are easier, in my opinion.
Yeah, I agree. Today, you can't use internals just for reference on other markets. Internals are only for the S&P or Dow or NASDAQ. In terms of starting with a broader picture, for me, crude oil at this point is in a low volatility coil. These are the terms I use. It's at a value area. It's compressed between the moving average, the trend lines. Really, it's had two traps. You're right. Trap 1, which is your bear trap. Trap 2 is your bull trap. So it's still in these boundaries, so I really wouldn't be that interested except from an intraday standpoint, but even then, waiting for oil to break above 100 or particularly beneath 85, but for trading, same kind of issue. If it breaks a trend line, it can usually go to the next level. Yeah, this is one that it's in a compression zone. Gold was like that recently, where it's just there's not a whole lot of opportunity for swing traders. Intraday traders, yes, but I don't trade oil again. I focus on the S&P. But yeah, you see this kind of movement here. It's what do? You get a trend line break here, 3 bars, just violent action. It was just reversed right back to the top. So you can play. That's in the context of a trading range.
Typical day for oil.
Yeah, that was typical. Yeah, that's seriously typical. But yeah, but it's one of those factors you probably want to. If you're if you're an expert, that's again risk tolerance. If you understand and have done this, and understand the character of the market, by all means. But if you're a new trader, please take my word for it. And Mike, I'm sure would agree. Keep it simple. Don't run off and try to learn Elliott wave, advanced level, Fibonacci, da-da-da. Just trend line break, moving average, divergence maybe, and keep it in that. And try to base your strategies based on what's comfortable to you, not somebody else. I've tried different methods in terms of more aggressive breakouts. I don't like breakouts, just personal factor. I don't. They tend to work well for those that can handle them, but I'm always either exiting too early. This is going back to oil on the 24th. This was a breakout trade, which it was. Forget the dots, but breakout above 94, thereabout, retracement trades. But I take profits too early, and there's really not a target. So you need breakout strategies in general. You can, again, test these out statistically, but in general, in generalist terms, tend to have lower success rates, really lower than 50 in a lot of cases. But what they do is the winning trades more than make up for the losers. But if your psychology, if your mindset, if your experience level, if you're, you don't like losing trades, I don't, no one does, you probably can't hold on for those winning trades, and so you'll self-sabotage. And that's just it's a mismatch of system with a trader. Retracements, in my experience, is just much cleaner, safer, lower. If you have a loss, it's smaller. The target is fixed. You know where it's going to trade to. You know if it's doing something wrong, etc. So yeah, and of course, reversal trades. We even talk about those, but that's a whole other styles of trading.
Okay, let's see. Scott is asking. He says he trades the E-minis, and he's looking for a good breadth indicators. He tried writing down the advanced decline ticker symbols, but he couldn't get all of them.
Okay, yeah.
And also he says, do you know any good resources to develop an understanding of breadth? Well, I mean, this webinar, you went over it in a few slides what the breadth is comprised of. It's going to depend on what platform and what data feed he's using as far as the symbols.
See if I can do that. Yeah, exactly. Breadth is, and that really is, stock charts, TradeStation, Mirus futures, e-signal, whatever you're looking at is going to, see, here's my internals chart. $AD SPD is your specific SP 500 breadth, which is diverging, by the way, at this moment, but that's different. So new highs, new lows also count as breadth. you can really, just using a TradeStation as an example, index breadth, or just, let's see, decline. So there's your, I mean, that's just the word decline, which is declining issues. Look at all that you can look at. You can look at the advanced decline of the NASDAQ 100, NASDAQ Dow 30, and that's just talking decliners, advancers. And again, you're going to have to look at the program that you use and what they have. That just takes a little bit to learn it, but
right.
And you're going to compare. What's most important is comparing divergences, so and not the absolute value. I did the same thing too. You know, S&P breadth is 400. What does that mean? S&P breadth at 400. This is a 15-minute chart of June here. So what's more important? The fact that it's diverging, that it bring a new breadth high on the 17th, and as the index S&P pushed to 1650, the S&P specific breadth, we've been talking specific terms, 353 stocks was a breadth reading at the absolute high, and the prior was 443. So that's
right.
You know, the differential there. But you're just looking at, again, it's not, keep it simple, not want to be complicated. We draw a little area there. This is not this. This is different. And what we're seeing now, this is not that. It's just you're comparing price highs with oscillator highs, and that's what you're looking for. It's just divergent. Of course, div on the lows too. But anyway, yeah, breadth is going to be specific. The symbols would be applicable to what you're using for your platform.
And Scott, also, if you just do a keyword search.
Yeah, again,
Oops, sorry. If you just do a keyword search for breadth, there's a thread on
okay.
BMT that's got some really good info too.
Good.
Okay.
Good.
Let's see. Wayne is saying, in an uptrend, do you use the LBR 310 or the MACD 310 negative histogram to enter longs?
No, and Linda's one of my, I have love her education, love her knowledge. I've learned so much from her. I'm thankful that she shares her knowledge. So the 310 oscillators, I've adapted that from her. But I don't use, Linda's much more systematic than I am. And so she uses this as, she can test these things out in terms of the 310 moving average or the signal line of the actual MACD. I just for personal preference, I don't use that. I like to look at just for non-confirmation confirmation. So she's using, there'll be if I can draw the hers on there, and you can see the differential. Let's whoops, that's a space. But the differential of that is just going to be, it's just a custom indicator. Let's see. Yeah, just a typical, I think actually you can download this for a TradeStation user from her website, lbrgroup.com. But all I've done is take that moving average out, and it's the same thing. She'll use it for signals. That never spoke to me, and I never quite was able to understand that properly. And there's actually trades you can take, the ante, the first cross, etc. But what I use it for is it's just a simplification, kind of a gross simplification, which is non-confirmation, looking at the price highs and price lows themselves. Right. And just the same thing we look at for rate of change, and of course tick and internals, and is the price high making a consequential or subsequential new high? If so, we'll buy the retracement. If not, this is a 1-minute chart, so not much can go on that. But this is 12:30 today, little in an uptrend. So non-confirmation in, this is the same indicator, just take away the signal line with tick and all that. So if you want to scalp it, fine, you can scalp that, but I want to go ahead and trade the retracement, which is broader picture. But yeah, she uses a lot more with the indicator than I do.
Well, we're lucky she's done 2 webinars in the last 2 months on BMT, and actually on the one that she just did Monday this week, she was also talking about rate of change a lot, which I noticed she used.
Yeah, this is mine just a simple rate of change. It really mirrors the other ones, even in that. What we're all looking for is similar. Let's see. She's very that different than two, but yeah, rate of change, oscillator. It's all going to be very similar. So that's I use a standard rate of change with this, make it a little bit larger, but it's all measuring price relative to itself. So there's a spike on the gap and et cetera. So we're looking at similar issues. We're all looking at supply, demand, price. Right. So spikes in rate of change, her oscillator, this custom oscillator, tick. You should be seeing confirmations in all of them.
Right.
They all show very similar metrics. It's if it's a supply-demand imbalance, that's what we want to pick up on. If there's a weakening or divergence, we want to pick up on that too.
Okay, so let's see if we can get a couple more of these questions knocked out. Grace asking, when you look at the advanced decline, I think is what they're saying. Do you look at it as momentum for the first time it dips below the low? For example, May 22nd, since it then made multiple lows in the negative 1500 to negative 2000 range and multiple highs at positive 2000. Can you elaborate on this?
Yeah, that was. Are you referring to the chart or the? Let's go to the chart because that's something we can look at that. To the chart there, because that'll show the actual numerical values. It was sort of. I remember in real time. Let's kind of put ourselves back in real time here. I do a daily commentary for members, and I was discussing, that was one of the topics, is that we've seen these, and it goes in real time. We don't know the market's going to fall back to 1550, but here's a real-time conversation that we had in the reports and with other colleagues and members, which is your breadth just pushed down to new lows. And let's go back to the tick chart quickly. And what we'll show, let's see the tick. Yeah, so what we're seeing in this, as the market pushed lower, was tick readings. You also saw it in breadth too. That this is at the highs. This is, you can't say it that well, but this is the absolute high in the market, and this is the Dow at least. You're seeing the tick push down to lows not seen since November 14, and even before that, not since June, July, basically June, July of 2012. So as the market was at these levels, the discussion was, I even said, in hindsight, we'll look back and say these pushes to new lows in the oscillator would be a kickoff that says the market's going to fall. Whatever the terminology I use, that's what wound up happening is that was the initial signal in real time that the market was in danger, and you can see the internals too. The push down to levels of the S&P specific, but it's the factors tick breadth. We can also look at breadth for that matter. Let's see if we can go back. Let's see, I have breadth on a different one, but market internal chart. Let's see, yeah, it's just kind of a messy screen, but we're going to show the internals. It's not that one, I don't think. Let's go one more. Well, what's happening in terms of presentation? There we go. That's what I want to say there. Is breadth. This is my big three market internals, which is tick, breadth, and the volume differential, which is your breadth volume applied to it. And so you can't really see that. Let's see if we can go back as far as we can. This is what's happening in real time, let's say. You're analyzing, you're trading, you're setting up the next day. We'll take Volt off because we didn't talk about it. But in terms of tick and in terms of breadth off the high, before the sell-off, this is coming down, breadth is making a new low that exceeded the one in April, and tick is making new lows, again, not seen since November. So you really have to look way, way, way back. And in fact, even on this time frame, the 30-minute chart, you're not seeing it. So this is what I'm talking about, the Wyckoff, with the kickoff, the sign of weakness in this case. It's an indicator that the absolute level is not important because that's just relative to volatility. It's the relative performance of price relative to the indicator. So as price is coming off of 1680, 1685, this is not, in terms of the big picture, in real time, this is not that much different than that. And what did tick do at this point? Breadth and tick, they diverged into the middle of early April. But what's happening is that breadth is sending us a message that price is not telling us. And that's the key in terms of the Martin Pring style weight of the evidence. Something is going on outside the norm with breadth. It's making new lows. Why is that happening? Well, in this case, you would say there's a larger scale supply-demand imbalance that the breadth internals are giving you hidden or secret signals that the market is in a much more structural, weaker level than you would otherwise assume by price alone. And that wound up being true because the next movement was a push lower to not just once, but where we bottomed at 1560, thereabout. So, and of course, you even see newer lows there. So I would really caution you on being bullish because of that same kind of issue. You're seeing lots of new tick lows, lots of new breadth lows, and divergence on the rally.
Okay. Real quick, is the term kickoff, is that a Wyckoff term or is that a Corey term?
That's a Corey term.
Okay, I thought so.
I like to poll my readers and my members, especially on the intraday reports, and say, "There's this thing. What do you want? What is it?" We use the word stick save kind of similar issue to that. It's just a trap, essentially. This would be a stick save. We all make up our terms, and so everybody you look at as an educator, which would at least it does their own kind of analysis. It's all the same concept. It's make this your own, make this special. Flag. There was a point in time, we use the word flag all the time now, where that was not a term that call them technicians, but chartists back in this 1930s, 40s didn't use. That was a Schabacker, Edwards and McGee, Charles Dow. I don't think used the word flag. Charles Dow didn't use the word head and shoulders, but those things happen. So if you can put it in your terms, and if you have a better term or a better understanding, absolutely use it because it makes it your own. It makes it personal, and plus you can reference it as opposed to a price makes a new low. The indicator makes a new low when price is, just coming off a high. Well, that's a very complicated way to say kickoff.
Right.
Wyckoff would use the word sign of weakness, and even that's too big. It's a kickoff. It's a throwing a ball in the air really hard. So just kickoff, that term, that word, summarizes an entirely much larger concept that says, okay, gotcha, I know what that means now. I know what to do.
Right.
Or flag or head and shoulders or whatever the case may be.
Okay, let's do two final questions, and then we'll move on to the prizes. So one question is, how much do you use volume? How important is volume analysis in your trading?
I didn't do volume in today's presentation, but volume's going to be important looking at, I think, not so much intraday. What you need to do on that is compare relative volume, and that's done in Excel. I didn't go through that in today's presentation, but you're looking for the same thing in terms of non-confirmation. So look at the S&P. This is the S&P 500. Look at the volume itself at the left side of the screen. So stronger volume at the start. So you pull it to a annotation phase. So it's really the same thing. As you see volume coming up off the lows, you typically want to see it stronger. Wasn't super strong, but then the remainder of the trend, and at the very end of it, volume really declined the whole way. And so as the market began to sell off, you see spikes in volume, spikes in sell volume. These are early warning signs of distribution. And, of course, you see the Fed-induced reaction. Of course, end of the month rebalancing, and lots of fun stuff happened there. But volume's high. Of course, that was a option expiration date and rebalance. There was other factors in this particular volume spike. But either way, volume was going down in aggregate as price was going up. So what you don't want to see as a bull is price go down and volume go up. That would signal distribution. You didn't necessarily see that, but on this rally, make that green, I guess, you're just comparing price. So if you're looking for the odds of this being the bottom, Alpha 1600, you would say this is a warning sign because volume is going down. As the market is retracing up, rallying up from 1600, what is volume doing? And the fact is it's declining. Let's actually zoom in on that just for the point. I won't show it that way, but this is kind of the point. You're looking to compare. It's all about comparing price relative to something as a reference point. And so this is your rally. So what is the market trying to do? Market profile concept. Trying to rally, trying to go back to the new high, trying to find support, trying to trigger a bull flag and break higher. But what does volume say? It says, it's not quite working. You have an ABC move up, or at least a reaction up, where the market's trying to take out the new highs. But on the 1650 area, it's the day before the Fed day, you have volume pretty much collapse. And granted, had the Fed said something different, and maybe the market would have gone higher. From a technical purism standpoint, this down move is exactly what should have happened, given volume, internals, and all that kind of fun stuff. Maybe the Fed was just a consequential reason to sell the market. It just, no matter what the Fed said, the market was going to go down, whatever the case was. It's just technical purism here with volume relative to price.
Right. Okay, one final question, and then we'll do the prizes. Just a general question about stops and targets and risk and reward. So let me ask you, do you base stops on price action or based on a set number of ticks? Do you base targets on, always twice your stop? Do you have any kind of limits, like I will only take a trade if the risk reward is, greater than 2 to 1. On the reward side, how do you look at all those things?
For retracement, they're going to be individual. Well, I hate to be all conditional, but individual based upon the trade itself. So retracements will get a little bit more focus or more position. If it is a trend day, I tend to be much more active, much more risk tolerant or risk taking on a trend session. That's when where the market tends to. Let's see if I find one recently. Theirs will be a trend day. Zoom it back a little bit. Gap lower. And especially the higher time frame. Again, this is where you can't test out my methods. It's the way I do it because I'm looking at the higher time frame. Every single night I plan out the next session for a pathway. But when looking at the actual trades, I'm much more aggressive to trade pro-trend day retracements. You would just look for 2 ES points, 3 points for a stop. The wider, the better. And in terms of volatility functions, you typically need to widen the stop if it's a more volatile day. Widen the target, but typically decrease position size. So what I like to have is an ABC 1, 2, 3 trade. So 2 would be my typical contract size. 3 would be that specific written down objective factor. It is a trend day. It is moving in my higher time frame direction. It is doing factor X. It was a clear retrace, factors written down. And you would trade more size on that versus a 1 trade, which is I just want to kind of play it. It's not quite working out. The market's not quite in a trend day. It's sort of following the rules. I'm just going to put on, 3 or 4 contracts, or whatever you want to do. Just kind of a probe position. That's when you don't have conviction in. And of course, you'll play tight stops on that, maybe tighter targets, etc. But you're going to have I would recommend at least having a fixed size, circumstances where you can go larger and usually widen stops with that, and size where you would go smaller but still want to participate. So it's going to be different on each person and what you're trying to do. Trend day, volatility, if it's working in terms of the higher time frame thesis, and again, I don't typically trade reversal trades and more retracements. I don't play breakouts for that matter much either. Retracements are my key. So it's a fixed stop, fixed target, and playing those depending on day structure and volatility.
Okay, so with that, are you ready to go to the Q&A? And so what I'm going to do is just ask for whoever has won the prize. I'm going to ask for their BMT username, and then when the webinar is done, I will send them a private message, and I'll get their autograph request and their mailing address and everything. So guys, have that ready. And Corey, you have the answers, so you're going to help me pick the right person out of the answers, right?
Okay, let's see if we get that. Yeah, I am ready.
Okay, go ahead.
Okay, let's get the screen share. So it'll be the first person to answer on the first question, second on the second. Is that how? Just making sure.
Yeah, that's how I normally like to do it. My only concern is that on question 10, we'll be looking for the 10th right person. Yeah. So we'll have to just see if there's enough people that are here. So we can try it. Okay. See what happens.
Let's do it. So good luck. And so we'll go ahead and make this larger. Ready? All right. Question 1. Fill the blank. Martin Pring defines technical analysis as the art of identifying I kind of gave it the answer there, blank, as early as possible. I'm going to make it easy. Yeah, Grace got it. Grace got it for the trend reversal.
Okay.
I did the Q&A last time, and Mike was make these questions easy, so no gray area.
It's all in good fun. All right, so Grace, I need your BMT username. And by the way, so this everybody that wins today, this is for an autographed copy of Corey's book, in case I didn't already mention that. Okay, Grace, thanks. So let's go to number 2.
Grace. Question number 2. Fill in the blank. According to the trend principle, trends have greater odds of blank than of reversing. Number 2, got it. MJ. Looks like on my screen, John Lockhart? John Lockhart, yeah, because no. MJ got it first. Andrew Stanton. Andrew Stanton got it second. So Andrew Stanton, what's he won?
Okay, so Andrew, I need your BMT.
A lot of people got that there.
Yeah, one thing I've noticed after doing this.
Hang on, wait, somebody. Oh, wait, 1 second. Well, we'll give it to Andrew because give it to Andrew there.
Yeah, Grace, I got your ID. So Andrew, I need your username. Yeah, one thing I noticed this month is that the winners are taking notes in Notepad and they're cutting and pasting. That's how they're so fast. So
That's a good idea.
Yeah, I've been impressed. So still waiting for Andrew's username. Come on, Andrew. There we go. Thanks, Andrew. Okay, number 3.
I'm more of a note taker with hand, but yeah, that works too. Okay, question number. Wow, we go backwards. Yeah. Question number 2. There are 3. Here we go. According to the momentum principle, divergences often precede. We've already got it. Yeah. So number 3 would be. Make sure you get this right. Looks like I'm gonna pause it. 3 is Peter O. Peter O.
Right. Okay, Peter, need your username.
Trends have greater odds of continuity, and then divergences precede reversals. Y'all are awesome.
Okay.
All right, everybody.
Yep.
Okay. Number 4. Number the 4th person to answer. Multiple choice. You can use a letter. A surge of momentum during an uptrend suggests that we should trade reversals, fades, or retracements. Looks like I gotta pause it. It's the answer is retracement, and that is third person to get it correct would have been
fourth person.
I'm sorry, yeah, 4th person. 1, 2. Looks like Jerry M.A.
Right. Okay, Jerry, I need your username, please. Okay.
Okay. Question 5. This will be the 5th person to get it correct. Okay. What term best describes a surge in momentum to a visual new high, oscillator high, while price is not making a new high? This is one reason we define things. We define things because it's so much more easy to say that.
And we're looking for number 5, right?
And yeah, number 5. It's a surge in momentum to a visual new high while price is not making a new high. So that is, it's a kickoff. Someone said divergences, but it's a kickoff. Its price is not making a new high. So we'll do some math here. 1, 2, 3, 4. I'm thinking LR.
Yep.
Is that correct?
Yeah.
LR.
Okay. LR, need your BMT username. Congrats. Okay.
Okay. Number 6, ready? And the 6th person who is correct. All right. One internal indicator best describes the number of advancing issues minus the number of declining issues, which is advancers minus decliners. No, I go back. Yeah, there we go. Question number 6. All right. Breadth is correct, and we have 1, 2, 3, 4. 5, 6. Is it BP? I'm thinking. Do a double check there.
1, 2, I think it's. Isn't it Mark, or did I miss one?
I have features operator.
Right.
LH,
Right.
Greg, Scott, Peter, and BP.
Oh, I didn't see Peter. Okay.
Yeah,
Yep.
Peter. Yeah. So BP, BP, capital B, capital P.
Okay. BP needs your username. Okay. Congrats.
All right. Number 7, the 7th person. This is strategy here to get it correct. You don't want to be the first. Don't want to be the first, right? Number 7. What internal indicator best describes the number of issues ticking higher minus the number of issues ticking lower? This is not a trick question. Attempt at humor. 2, 3, 4, 5, 6, 7.
It's funny because you can see everybody kind of
thank
slow down a little bit, so they're trying to be number 7.
I know, right? All right, we got 1, 2, 3, 4, 5, 6, 7. Looks like the futures operator.
Right.
It's been early on lots of them there. You got it, futures operator.
Okay.
2,
And that's your username, I'm pretty sure. So.
good job.
Okay. Good job. Yeah. Number 8.
Okay, wait, 2 more. Good luck, good luck, good luck. Number 8, so don't jump in first. Okay. All right, well, quick. Make sure a kickoff signal is confirmed with a price signal such as a breakthrough above a, and I'll take up to 3 answers that are correct. And you got the exact, I love it. You're all fine. Yeah, let's go. It's trend line, moving average, reversal candle high, da-da-da-da. Trend line looks like what everybody said. So we'll take the forward trend line, just TL. 1, 2, 3, 4, 5, 6, 7, 8. B, F, capital B, capital F.
Right. Okay. I need your username, please. Okay. I need that in order to get you the book.
So we do.
Well, Yeah, I'll try to give him until we're through, so we can go ahead and go to number 9, and he can give me the username as soon as he's got it.
Okay, excellent. Question 9, so it'll be the 9th person to answer. What is the two-step, I've been 2 words here, two-step process we discussed that often precedes a trend reversal? I kind of gave you a little clue, but it's two words here in order. It's a hard copy. Somebody's asked about a hard copy. It's a hard copy of the book that I'm going to sign and send to you.
Right.
Wow.
So we're looking for number 9 here.
Right, okay. 1, 2, 3, 4, 5, 6. It looks like, you got your caps lock like what you won, Jeff Hager.
Right.
Jeff Hager. The divergence, and very good. Y'all are amazing.
All right, Jeff, and age your username.
Oh, divergence.
Okay.
Jeff Hager.
All right,
10th number 10,
last.
this is it.
Yep.
Here we go. All right, 10. Multiple choice, A, B, C, D. After a trend reversal is confirmed, which retracement or flag tends to have, at least what I said, has the best odds of success? First, second, third, fourth, fifth, sixth, seventh, eighth, ninth, 10th. Yeah, everybody got that. It's first reaction. Also has the best risk-reward characteristic. Okay, 1, 2, 3. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Maybe check my list, John. Oh, you got like, oh, that's not fair. You did 4 answers. How you do with that? 1, 2, 3, 4, 5, 6. Does that count if we did 4 answers in a row?
I think it's Doug. Yeah, Doug P would be the right answer.
Doug, yeah, let's see what we got. Doug.
All right, so Doug needs your username.
Doug got it. Yeah.
Yeah. So Doug, give me your username, and I'm still waiting on the username from 2 answers ago. Also. Okay, so while we're waiting for those 2 guys, so Corey, I want to thank you for all of your time for the presentation and to answer all the questions today, and definitely look forward to having you back here in a few months as well. Any plans for another book?
I have a couple of options. I think I want to do like an online course as opposed to a book. I love webinars. I like face-to-face work. Yeah, there's a couple of ideas I'm kicking around for one of which is called teach. Well, I wouldn't say ideas, but yeah,
Okay.
One on intraday trades, one on teach me to trade. Yeah, there's 2 or 3 ideas, but when you write a book, I mean, Linda Rashy, I talked to her about books. When you write one book, you're just like, oh my gosh, it's so draining, and so I think doing an online thing would be a lot more fun, more interactive, and I mean, books are just so formal. So and yes,
I've heard that a lot.
Yes.
We have a lot of authors on, and they pretty much all say the same thing.
Yeah, I'll do one again, but yeah, I need to. We'll see. I think my next project will be a big online thing.
Okay. All right. Well, good job, Corey. So thank you again, and also thanks to Bob at Mirus Futures for giving us an overview today and for introducing us in the first place. All right, guys. I'll post the recording of this webinar on YouTube sometime tomorrow, and you can check it out there. Thanks, Corey. Thanks, guys.
Thank you, Mike. Thank you, Bob. Thank you, traders, for coming, and be safe. Take care.